We have Radhika Rao, who is a senior economist, executive director at DBS Bank, joining us this afternoon. A very good afternoon to you, Radhika. Thank you so much for joining us. This is Cheryl on the other side. And like I said, my opening statement was like the question to you. We've seen a stimulus blitz actually take place in China on back of that aggressive stimulus, which was one of the much or most needed factor coming in to revive the Chinese economy. We've seen that actually at play over the last 1 week or so. But where do you think that makes us stand vis-a-vis China now?
Hi, good afternoon. Certainly, I think what stood out in China's measures, and we have to remember that there have been off and on in the past few quarters measures here and there. I think to mainly targeted at lowering the cost of financing. So a lot of supply side measures that Chinese government had explored and had unveiled. But I think what stood out this time was obviously the urgency, or the urgency in the tone, as well as wider choice of measures, from rate all the way to property measures and so on and so forth. And then there is obviously this chatter that they could bring about more consumption-focused measures, as well as trying to recapitalize banks. So host of measures from the government as well as the regulators. I think that's what gives an underlying sense of urgency in the stimulus measures that have been announced. Insofar as India is concerned, I would think that overall, of course, for the markets, as you've seen in the past few days, there is a concern that there could be there could be portfolio rebalancing, which could favor some of the cheap valuation Chinese stocks. And I think that's why you've seen a bit of tepidness in the market price action. But that said, much part of the gains that India has seen, or Indian equities have seen, have been also on the back of higher retail participation. I think so that remains wedded to the domestic equities. In terms of the macro, I would think India's growth has been mainly on the back of its own steam. In terms of being domestic demand driven, especially investment spending driven. From households, from the government, from states, as well as some parts of private sector as well. So I don't think that will see a major difference from what's happening in China. And the other one, of course, is selected export segments have continued to do well. I think one thing that we should watch out for is, of course, what happens to the commodity space in all. You just mentioned the metal indices, stock indices doing better. I think the commodity space, especially minerals, metals, some of which we import, what happens to the price action there, because that could translate into a wider import bill for us, for instance. I think these are some of the pass-through areas. But otherwise, I would think at this point, markets are still waiting to see. I think China has gone into a holiday at this point, but when they return, what these expectations, how much of that does come to materialize. I think that will be very important to watch. That will be important again to keep the optimism still high for those markets.
Totally take your point, Radhika. Very good afternoon. This is Shrishti also joining in. But with India's MSCI weightage rising, how might this impact the future portfolio flows for the Indian markets, and especially in light with the global shifts towards China, as there has been renewed optimism?
Certainly, I think India's weightage has gone up in the MSCI EM index, or rather, it's converging on a convergence path with China. And if you see the world IMI index, there too, India's weight is up marginally compared to rather more than China at this point. Investors have, again, I'm not an equity person, but from our conversations, what we hear is that the investors have come into Indian markets based on its own strong growth profile, as well as macro stability. So I think that doesn't get diminished because of Chinese markets or stimulus. But of course, investors on a whole who look at the region as a pack, they tend to always look at good pockets of opportunity. I think from that perspective, because of relatively cheaper valuations and, barring this week's price action, the markets were pretty haven't performed very well in China. So I think that is where the attractiveness lies. So some kind of churning certainly taking place. But we'll have to see, because I still do think that the higher retail participation in Indian markets have something that has provided kind of defense against what's happening with the foreign appetite. It's good time to see how much of that will hold up. Otherwise, anyone who's come in for the long term and the structural story, I don't think will be moved materially, just because of the positive things that are happening in China.
Right. Radhika, yesterday we actually had a slew of data that actually came about. When you talk about the India economic data, we had a current account deficit, which actually showed a widening trend in the Q1 of FY25. We also had the core sector data, which has actually come in a negative 1.8%. Versus 6.1% that we saw in the month of July. This is for the month of August. How are you reading into these economic data at this point in time?
Certainly, core data, that core or infrastructure industries index, as it's also called, the August numbers were not very, were quite soft. In fact, if you look at the sub segments, barring it's slowed across the board or it's declined in that month. I think that is certainly some part of it is also in terms of the weather conditions. We do think that because of the way rains behaved in the month, there could be some impact on output. We should remember that at the same time last year, actually the output was the rains were poor. So this time it really had played catch up in September as well. We tend to see in some pockets rains were still quite strong. So I think part of that weakness or sharp weakness could be put to one-off factors. But even if you look at April to August average of fiscal 25 vis-a-vis FY24, output has generally either slowed, barring in fact, it's slowed across the board, barring electricity. We have really seen slower output there. So I think again, we should watch the second half of the fiscal year to see what the trend looks like. But over the first half, I think we did have a few things which didn't happen last year. I mean, we had elections for one, and then weather for another. We'll have to wait and see how that works, because there's also parallel news on some of the steel majors highlighting the fact that there could be some dumping happening in the local markets, and the government also initiating some investigation into that coming from various trading partners. So again, those could be something that's also dampening output. So we will watch for second half of the year. At this point, we are basically maintaining our growth forecast and expecting 2Q FY25 growth to actually improve from 1Q 6.7%. Going to a current account, yes, I think the current account deficit did widen, but I do think it's quite marginal. In fact, for the whole year, fiscal 25, our forecast is about 1% of GDP. Trade deficit, goods trade deficit will be wide. But I think one positive there is that energy prices are quite low. And if that really holds up, then that means that import bill will be that much smaller. But like we discussed earlier, what happens to China's stimulus and metals will be important to look at as well. But while current account is an important piece, financing is equally important. And I think that's where we expect a bit of strength coming in from foreign, FDI flows, more importantly, portfolio flows. I think those will be very important offsetting factors for the current account. So while there is a marginal widening, for the year, we still expect the whole year's balance to be at very manageable levels, which is at 1% of GDP in terms of the current account deficit, and for the financing flows to be more than enough to create an overall balance of payments surplus. And finally, I mean, you can see the benefit in the reserves as well. I mean, foreign reserves are at record highs, and that does provide a very important defense for any untoward, price action, especially in the currency.
All right, Radhika, I once again want to have your take on the kind of flows that India could be expecting, because at one point India's portfolio inflows have been strong, but the rupee remains an underperformer. So what factors are driving this disconnect between the strong inflows and a weaker currency, and how do you see this trend evolving in the near term?
Certainly very important to watch. I think that, disconnect has been playing out for quite a while, where even when we have pockets of very strong inflows, the currency hasn't really reacted as much. We saw that during the period also when the dollar was rising. You had seen a lot of the Asian currencies, for example, ASEAN currencies as well, weaken very sharply, especially if it's Malaysian ringgit, Thai baht, Korean won. We had seen them underperform. At that point, the rupee was in fact one of the regional outperformers because it was held relatively stable because of active intervention efforts. And on the way down, which is that the dollar is now softening, many of the ASEAN markets have made up for lost ground. But the rupee has again chosen, has been stable. It's now the regional underperformer. So that disconnect has been playing out, and I think that disconnect can be explained by two reasons. I think the first one is, of course, the authorities looking to correct rupee's outperformance on the real effective exchange rate basis. That is rupee vis-a-vis its trading partners. Is it at competitive levels? That's first. And the second one is, of course, the reserves. Like we discussed earlier, reserves have risen from strength to strength. And I think policymakers, given the kind of backdrop we are in, see reason in strengthening defenses. And we should remember that reserves also are coming because of flows, right? These are not current account surpluses, these are by flows. So they do see reason in strengthening that defense as much as possible. I think this has contributed to the currency's underperformance. Looking ahead, our base case is that dollar will continue to soften. And if that's the case, rupee would also likely strengthen, but it's going to be relatively marginal compared to some of its regional peers.
As a take coming in the dollar, the rupee, and where it's headed from here on. But Radhika, I cannot not ask you about what about the interest rate cycle back home, because we have the Federal Reserve who went ahead with the bumper 50 basis point rate cut, though you had commentary yesterday coming in from Powell, which was a bit of a hawkish one, where he said that we will have to wait and take it easy when you talk about the future rate cuts. But what's your take back home? MPC will be meeting next week. What are your expectations? What have you all penciled in when it comes to the interest rate scenario or interest rate cycle back home?
Certainly, what the Fed did, I think, is a necessary but not sufficient reason for the RBI to go ahead and ease rates, urgently, right? I think the governor has made it quite clear that India will act on domestic reasons. Fed does matter, but it'll be overridden by what domestic considerations are. At this point, rest of this week, we are really waiting for one important announcement, which is that who the new external members for the MPC would be. I think they would sit in for the upcoming meeting. It'll be once their names are announced, I'm sure the markets will glean through what the stance of each of these MPC members are. So that's the kind of backdrop that the RBI has on hand. Domestic inflation had eased in July, August. RBI knew that was coming. They had highlighted that they would look through it. So inflation well behaved, but likely to pick up. New MPC members and the Fed that has acted, but acted on the domestic reasons on their front, and RBI will act on its own domestic justification. So putting these three things together, we do think that October meeting would be more to maintain status quo. We would be very interested in hearing the commentary, whether the RBI sees reason in sounding less hawkish. Inflation overall, in our mind, is still trending lower, right? Fiscal 25, it's settling into a new lower range. So that we think should satisfy the central bank insofar as we are closer to the target, that they see reason in gradually easing. So we do see rate cuts coming, but we don't think that will kickstart in October's meeting. I think it will be closer to the year end, which is end 2024.
The anticipation about the interest rate cycle, or if there is going to be a cut back home. But what Radhika is of the view, it will be towards the end of 2024. Thank you so much, Radhika, for joining us on the show to give us an overview of what exactly is happening across the globe and what does that mean for India. But on that note,
there comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits and then break right through them. Become something more. It's my time to rise.